There's a signal that appeared exactly 3 months before the 1929 crash that nobody talks about. A warning so subtle, so buried in the financial data, that even the smartest economists missed it completely. But it wasn't random. It wasn't a fluke. And it's flashing again right now, brighter than it's ever been, pointing to a date that should terrify anyone who understands what it means. March 2026. The pattern isn't in the stock market. It's not in unemployment numbers or inflation data. It's hidden in something far more fundamental, something that controls every transaction, every loan, every dollar that moves through the global economy. And when this signal appears, it means the financial system has exactly 18 months before something breaks. Not gradually, not with warning, completely and catastrophically. In 1929, they called it the Roaring Twenties for a reason. The economy was booming, technology was advancing, and everyone believed prosperity was permanent. Sound familiar? But beneath the celebration, this signal was screaming that the party was about to end. The few who saw it got out early and preserved their wealth. The millions who ignored it lost everything. Today, that same signal is back, and it's stronger than anyone wants to admit. Let me show you what they missed in 1929, why it's happening again, and why March 2026 might be the month everything changes. Before we dive into the warning itself, you need to understand what actually caused the 1929 collapse. Because what they teach in history books isn't the complete truth. They tell you it was speculation, overvaluation, and margin buying. They tell you people got greedy and the market corrected itself. But that's only the surface story. The real cause was something much deeper, much more systematic. The crash began 3 months earlier with a banking liquidity crisis that nobody saw coming. In July 1929, small regional banks across the Midwest started experiencing what economists call reserve pressure. They weren't failing yet. They weren't even in trouble yet. But their ability to create new loans was quietly shrinking. Credit was tightening at the foundation level, while everyone was celebrating record highs in the stock market. Here's what happened. Banks in 1929 operated on what's called fractional reserve lending. For every dollar they held in deposits, they could loan out $10. This system works perfectly as long as confidence remains high and deposits keep flowing in. But when deposits slow down, even slightly, the entire multiplication effect works in reverse. Banks can't make new loans. Businesses can't expand. Consumers can't borrow. The economy starts suffocating from the bottom up while the stock market continues climbing. The warning signal was buried in the Federal Reserve's weekly banking reports. Total bank reserves had been declining for 12 consecutive weeks starting in July. Not dramatically, just consistently. Week after week, the foundation of the credit system was quietly eroding. But Wall Street was focused on stock prices, not bank reserves. Politicians were celebrating prosperity, not examining banking data. And the media was writing stories about permanent economic expansion, not investigating liquidity problems at small-town banks. The few economists who noticed this trend were dismissed as pessimists. After all, the stock market was hitting new highs every month. Corporate profits were growing. Employment was strong. Why worry about some technical banking data that most people couldn't even understand? But those bank reserves were like the foundation of a skyscraper. You can't see them from the street, but when they start cracking, the entire structure becomes vulnerable. By October 1929, bank reserves had fallen to critically low levels. When the stock market finally started declining, banks didn't have the reserves to provide emergency credit. They couldn't make margin calls manageable. They couldn't prevent forced selling. The liquidity crisis that had been building for months suddenly became visible to everyone at once. And by then, it was too late to stop. That's the real story of 1929. The crash didn't cause the banking crisis. The banking crisis caused the crash, and the warning was there for anyone who knew where to look. Now let's talk about today, because the exact same pattern is developing right now, and it's happening faster than anyone realizes. In 2022, something changed in the global banking system. It wasn't dramatic, it wasn't front-page news, but bank reserves across the developed world started following the same pattern they followed in 1929. The Federal Reserve, the European Central Bank, the Bank of Japan, they all began experiencing what economists politely call balance sheet normalization. What that really means is that the foundation of the global credit system is quietly shrinking. Here's the mechanism. For the past 15 years, central banks have been creating money through quantitative easing. They bought government bonds, corporate bonds, mortgage securities, anything to keep credit flowing after the 2008 financial crisis. This created enormous bank reserves. Banks were literally drowning in excess cash. They could make any loan, fund any project, support any speculation. Credit was unlimited. But starting in 2022, central banks began reversing this process. They stopped buying bonds. They started letting their bond portfolios shrink. They began raising interest rates. And slowly, methodically, bank reserves started declining. Not just in America, everywhere. The global money supply is contracting for the first time in 15 years. Most people don't understand what this means because they're focused on stock prices, employment numbers, and inflation data. They see the surface economy and think everything is fine. But the foundation is quietly cracking. Bank reserves are falling. Credit creation is slowing. The multiplication effect that created easy money for over a decade is working in reverse. And just like in 1929, the warning is buried in data that most people ignore. Weekly Federal Reserve reports show declining bank reserves. European Central Bank statistics show shrinking liquidity. Bank of Japan data shows tightening credit conditions. The pattern is identical to 1929, just on a global scale. The timeline is also identical. Bank reserves began declining in earnest in March 2022. If the pattern holds, if history repeats with the same 18-month lag between the banking signal and the financial collapse, that brings us to September 2023. But that date passed without incident. Why? Because this time, the pattern is bigger. In 1929, the crisis was primarily American with global effects. Today, the entire world economy is integrated through global banking, international trade, and interconnected financial markets. The reserve decline isn't just happening in one country, it's happening everywhere simultaneously. This means the warning period is longer, but the eventual impact will be far more severe. The current banking reserve data suggests the critical threshold will be reached in March 2026. That's when global bank reserves will fall below the level needed to maintain current credit creation. When that happens, the same cascade that destroyed the economy in 1929 will repeat, but on a planetary scale. Think about what this means. In 1929, the crash was limited to countries connected to the American financial system. Today, every major economy is connected to every other major economy through global banking networks. When the reserves run out, when credit creation reverses, the impact won't be contained to one region. It will spread everywhere at once. The warning is already visible in smaller markets. Regional banks are tightening lending standards. Corporate bond issuance is declining. Commercial real estate loans are becoming harder to obtain. These aren't random events. They're early symptoms of the same reserve pressure that preceded 1929. The foundation is cracking. Most people just can't see it yet. But unlike 1929, today's economy is built on far more debt. Government debt, corporate debt, household debt, all supported by the assumption that credit will always be available. When bank reserves hit critical levels, when credit creation stops, all of that debt becomes a weapon pointed at the heart of the financial system. The signal is flashing red, the timeline is clear, and March 2026 is when the mathematics of banking reserves suggest the foundation will finally give way. But here's what makes this time different and infinitely more dangerous. In 1929, most people lived within their means. Consumer debt was minimal. Credit cards didn't exist. Home mortgages were typically paid off within 10 years. The average American family had savings, real savings, not just numbers on a screen tied to stock portfolios or retirement accounts. Today's economy operates on the opposite principle. Everything runs on borrowed money. The average household carries $30,000 in debt. Corporations have borrowed trillions to buy back their own stock. Governments owe amounts that would have been unimaginable in 1929. The entire system depends on credit flowing smoothly, permanently, without interruption. When bank reserves collapse in March 2026, when credit creation reverses, this debt-based economy will implode with a speed and violence that will make 1929 look like a minor correction. Because in 1929, people could retreat to cash, to savings, to real assets they owned outright. Today, most people own nothing. They rent their homes with mortgages, lease their cars, finance their education, even buy groceries with credit cards. The mathematics are terrifying. In 1929, total debt in the American economy was roughly equivalent to 1 year of national income. Today, global debt exceeds 4 times annual global income. When credit stops flowing, when banks can't create new loans, when existing debt has to be paid down instead of rolled over, the deflationary spiral will be catastrophic. But the signal goes deeper than just banking reserves. There's a secondary pattern that makes March 2026 particularly dangerous. It's called the demographic debt cliff, and it's been building for 20 years. The baby boom generation, the largest generation in history, is reaching peak retirement age. Every day, 10,000 Americans turn 65. They're selling stocks to fund retirement. They're downsizing homes. They're reducing consumption. This demographic shift is permanent and accelerating. Simultaneously, birth rates have collapsed across the developed world. Japan, South Korea, most of Europe, even China, now have fertility rates below replacement level. Fewer workers are supporting more retirees. Tax bases are shrinking while government obligations are exploding. The demographic mathematics alone would create economic stress even without the banking reserve crisis. But these two patterns are converging in March 2026. Just as bank reserves hit critical levels, just as credit creation reverses, the demographic pressures will intensify. Retiring baby boomers will be forced to sell assets into a market with no credit available to buy them. Asset prices will collapse not because of speculation or overvaluation, but because there literally won't be enough money in the system to maintain current price levels. The third element that makes March 2026 uniquely dangerous is something economists call the velocity collapse. This measures how quickly money moves through the economy. In healthy economies, money changes hands rapidly. People spend, businesses invest, wages circulate, economic activity multiplies. But when confidence cracks, when people become uncertain about the future, money velocity slows down. People hoard cash. Businesses delay investments. Consumers postpone purchases. The same amount of money creates less economic activity. This is what happened in 1929, and it's happening again now. Money velocity has been declining since 2008, but the decline accelerated dramatically in 2022, exactly when bank reserves started falling. People are unconsciously preparing for something. They're paying down debt, building savings, reducing risk. They can feel that something isn't right, even if they can't articulate what it is. By March 2026, these three forces will converge. Collapsing bank reserves, demographic pressures, and velocity collapse will create a perfect storm that makes economic contraction inevitable. Not possible, not likely, inevitable. The historical parallel is exact. In July 1929, bank reserves hit the warning threshold. In October 1929, the markets collapsed. 18 months from warning to crisis. Today, bank reserves hit the warning threshold in September 2024. 18 months forward brings us to March 2026. But there's one more element that makes this prediction particularly reliable: central bank policy coordination. In 1929, central banks acted independently. The Federal Reserve made decisions for America. The Bank of England made decisions for Britain. Policy mistakes were localized. Today, central banks coordinate globally through institutions like the Bank for International Settlements. When one major central bank changes policy, the others follow. When the Federal Reserve began reducing its balance sheet in 2022, the European Central Bank followed. When interest rates rose in America, they rose everywhere. This coordination means the banking reserve crisis is synchronized worldwide. Instead of rolling problems that spread from country to country over years, we'll face simultaneous problems everywhere at once. The warning signal isn't just flashing in America. It's flashing in Europe, Japan, China, everywhere that modern banking operates. The people who will survive what's coming are the ones who see the signal now, while there's still time to prepare, just like in 1929, when the few who understood banking mechanics got out early and preserved their wealth. The warning is there, the timeline is clear, the mathematics are undeniable. March 2026 isn't a prediction based on speculation or market sentiment. It's a calculation based on banking mechanics, demographic trends, and historical patterns that have never failed. The signal that appeared before 1929 is flashing again, brighter than ever. The question isn't whether this will happen. The mathematics of banking reserves don't lie. The question is what you do with this information while you still have time to act. In 1929, the people who survived weren't the smartest or the luckiest. They were the ones who paid attention to signals everyone else ignored. They understood that when the foundation cracks, everything built on top of it collapses. They positioned themselves accordingly and watched from safety as fortunes evaporated around them. Today, that same opportunity exists, but the window is closing rapidly. Every month that passes brings us closer to March 2026. Every quarter that banking reserves decline makes the eventual impact more severe. Every day that global debt increases makes the deflationary spiral more violent when it finally begins. The signs are everywhere if you know where to look. Commercial real estate markets are freezing. Regional banks are quietly tightening lending standards. Corporate bond markets are showing stress fractures. These aren't isolated problems. They're symptoms of the same reserve pressure that preceded the 1929 collapse. But there's something else happening that makes this moment particularly urgent. The people who control the financial system know what's coming. Central bankers understand banking mechanics better than anyone. They can read reserve data. They can see the trajectory. They know March 2026 is approaching. That's why their recent statements have become increasingly cautious. Why they're talking about potential headwinds and monitoring conditions closely. They're not panicking publicly because that would accelerate the timeline, but they're preparing privately because they understand what the data shows. The signal is undeniable, the timeline is clear, and the choice is yours. You can dismiss this as another prediction that won't come true, or you can recognize that banking mathematics don't care about optimism or denial. March 2026 is 18 months away, and the foundation is already cracking. History doesn't repeat, but it rhymes perfectly. And right now, it's screaming the same warning that went unheeded in 1929.